My presentation is on entrepreneurship and financing, and that entrepreneurship holds the enticing potential of what one author called the classic rags to riches story, where a resourceful individual transforms an innovative idea into a successful company. For this process to happen, usually the entrepreneur needs some kind of outside financing to help start up their company, and this financing process is what my research looks like. My research question compares venture capital and angel investing with crowdfunding as financing models for startups. And I use the relationship between the investors and the entrepreneurs as a lens for my analysis. So I'm going to start with some background information to provide context for what I'm talking about. And I'm going to start by helping explain the definitions of the different models. Venture capital started in the 1940s and has evolved into a fairly formal, structured model where the venture capital firm is an intermediary that pools investment money from other companies and then uses that money to invest in startups that they see as likely to succeed. Angel investors are a little bit more of an informal network. They're wealthy individuals who invest in startups, and it's a little bit more recent term than venture capital has been around for about 3 decades. Both angel investors and crowdfunders are legally accredited investors, and they both use similar strategies in their investment process. Crowdfunding differs from these two approaches a little bit more drastically, and it is a more recent model as well. It's emerged roughly in the last 10 years, and it involves taking lots of small investments from many, many investors around the country, around the globe, and pooling them to give to a startup company. And this term grew out of the older term called crowdsourcing, which refers to outsourcing a task from a normal business environment to the general population. In this case, for crowdfunding, it's the same idea, but for raising capital. A couple important things about the crowdfunding process are that it usually goes through an intermediary website that acts similar to a stockbroker. Indiegogo and Kickstarter are a couple of examples of those intermediary sites, and these sites connect investors and entrepreneurs and facilitate the transaction. Turning more to startups themselves, a lot of research shows that startups hold economic and social benefits for the areas they operate in. Recognizing this, several governments around the world pass legislation or make efforts to try and help make the funding process easier for startups. But despite this knowledge and this attempted help by the government, funding is often the hardest thing to come by for an entrepreneur trying to launch a new business venture. Some of the options that they have include a traditional financial intermediary like a bank, but typically, or in almost all the cases, entrepreneurs will be denied funding due to the high risk that banks don't want to take on. So entrepreneurs, in some cases, use what's called bootstrapping to leverage their personal resources they have access to in creative ways. Others try to engage with what's called friends, family, and foolhardy investors, and they're leveraging their personal connections and trying to get them to invest in their company. And more oftenly, entrepreneurs try and get capital from venture capital or angel investor firms, and that's their preferred method. But it's also worth noting that venture capital and angel investments are very competitive, and only 3 to 15%, depending on which research you look at, of the entrepreneurs who pitch their idea to these companies actually receive funding. There's so many entrepreneurs who are denied funding for a couple of big reasons. One is the high risk that's involved with them. This is also paired with the fact that banks, venture capital firms, and angel investors typically want larger investments than a lot of entrepreneurs are looking when they're first starting out. So all these factors combined create what's known as a financing gap, and that there's a shortage of capital for startup companies, which amounts to around $60 billion that is demanded but is not available on a global scale. So out of this environment, and partly in response to this financing gap, crowdfunding has taken off and grown rapidly. According to the crowdfunding industry report, around $1.5 billion were raised through this model on a global scale in 2011. That's jumped to $16 billion for 2014, and over 32 is a projected figure for 2015. So that provides some background context on what I'm going to be talking about. Diving back into looking at the investor-entrepreneur relationship, I'm going to talk about the regulatory environment, how it impacts these parties, and in some cases doesn't impact them as directly. But it does lay a legal framework and dictate a lot of the interactions between the two parties. So starting off with crowdfunding, there's 2 different approaches. One is rewards-based crowdfunding. It's been around since the birth of this model. So for over 10 years, where an investor or a donor will give money and receive small perks or products in return, but there's no equity transaction involved. The other crowdfunding approach is equity crowdfunding, which involves an investor purchasing partial ownership in a startup. So sites like Kickstarter and Indiegogo have typically relied on rewards-based crowdfunding, and partly because it gets around the regulations of the Securities and Exchange Commission in the US because there's no active equity crowdfunding transactions taking place. But this legal landscape towards crowdfunding actually changed in 2012 when Congress passed the Jumpstart Our Business Startups Act, or JOBS Act, which provided a more viable legal framework for equity crowdfunding and essentially created an environment where it was an economically viable option and legally viable option where it was not previously. There were some requirements that were attached to this, and that crowdfunding campaigns have to go through an intermediary website, similar to the way the model usually works, and that website has to be registered with the SEC. There's also caps imposed on the total investment campaign amount and total or maximum investment that an individual can put into the campaign. Shifting to venture capital and angel investing, the SEC is important here because it oversees the equity transactions that these companies are going through and is responsible for accrediting both angels and venture capital firms as investors. And this ties back to early stage financing, and that the SEC's regulations create a safer investment environment in the US, and that makes venture capital firms and angel investors more likely to invest in an attractive market and more likely to invest in early stage startup companies. So shifting notes a little bit, or going on a different part of the investor-entrepreneur relationship, the research that investors conduct into potential opportunities for startup companies is called due diligence. And so the investor will research a startup, and this helps start or initiate the interaction between the investor and the entrepreneur and helps set up this relationship. For venture capitalists and angel investors, due diligence is very important. They spend a lot of time and resources doing this research. Studies show that they spend between 20 to 60 hours or even more investigating each startup company, and that this due diligence does indeed increase the return on their investments. Crowdfunding, on the other hand, has a lot of difficulties with due diligence, doesn't really fit into the model. There's so many scattered individual investors with a smaller stake in the company that it becomes almost financially impractical for them to spend many hours investigating a startup when they're not going to actually have a large stake in it. So they typically don't spend a lot of time researching startups. The next section is about the involvement and management of the startup itself. So after performing due diligence or not, but deciding to invest in the startup, the investor themselves are involved with the startup management process in different ways depending on the financing model. But for venture capitalists and angel investors, they expect to play a very large role in overseeing the management of the startup, and they typically negotiate a contract which ensures that they have certain control mechanisms over the company and also usually ensures them a seat on the board. So the angel investors and venture capitalists have this control, and then they play many different managerial roles with the startup, including helping recruit employees, doing strategic planning, and connecting the startup with suppliers or customers. And this involvement helps develop the company so that the investor can then exit at a profitable stage a couple of years down the road. And then under crowdfunding, once again, the model varies from the other two approaches, and that it doesn't really lend itself to being involved in management of the startup. So for similar reasons to the difficulties with due diligence, and that there's a lot of scattered investors with smaller stakes, so it's not practical for them to spend a lot of time with the startup, and the startup also can't deal with 200 or 300 or more investors talking to them on an almost daily basis. All right. So the next section is about return on investment, and this comes out of the relationship that's been built up with due diligence and being involved in the startup. So the investor is willing to give capital to a startup because they want to earn a return on their investment, and any involvement they have with the startup is aimed at maximizing that return. So for returns, venture capital firms and angel investors on average earn profitable returns. One researcher found that venture capital firms earn on average a 5% risk-adjusted return, which is to say that they earn 5% more than an average or typical stock market investment in the United States. But For angel investors, the research shows that they earn typically between 22 and 27% total return, which is again higher than a typical investment. So the returns in general are positive, but it's still very high risk because roughly 10% of their investments account for 80 to 90% of the returns. And so that means that over half of their investments are losing money and being total losses in many cases where they lose all the capital that they put in initially. So it's still risky, but they earn profit on average. For crowdfunding, it depends on the model. So for rewards-based crowdfunding, investors or donors don't receive a typical return on investment, but they do receive an incentive or perk, which is typically delivered, but there's some risk here as well, as a lot of startups promise a product and then either delay it or fail to deliver it altogether, and then the investor can't get their money back. For equity crowdfunding, it's more complex, and the model is so new there's not very much concrete data about what returns will be, but the literature actually reveals a lot of differing opinions on what's likely to occur. The author Mashburn argues that the legislation in the US needs some revisions, but that equity crowdfunding can be successful for investors. Another author, if I'm saying his name correctly, Sperrer, argues that equity crowdfunding will allow the average investor or even lower income individuals to get rich quick by investing a little bit of capital and getting a high return. But on the other side of the equation, Michael Dorf, after conducting a very thorough analysis, argues that equity crowdfunding will likely yield poor returns, and I'll talk about the reasons for that more in a minute. So to quickly summarize the investor-entrepreneur relationship under venture capital and angel investors, these organizations or individuals are typically looking for larger investments. They spend a lot of hours on due diligence, and they're very involved with the startups, whereas crowdfunding is a different approach and where the investor is much more passive and is typically not involved with the startup either before investing or after to a substantial degree. So how do these differences in the relationship manifest in terms of their return on investment? As I said, venture capital firms and angel investors usually earn a positive return, but the more in-depth research on equity crowdfunding it yields different results and paints a bleaker picture for the future of crowdfunding. So crowdfunders, they don't have access in most cases to the risk reduction strategies or the profit enhancement strategies that the other models use, because they don't have the resources to conduct due diligence and they're not typically involved in managing the startup. And this is also paired with the fact that entrepreneurs prefer the other two investment models, and so the best startup companies get picked up by venture capital and angel investment firms, and then the startups that are less likely to succeed turn to crowdfunding. So for these reasons, it seems unlikely that crowdfunders under the equity model are likely to yield strong returns. But on the entrepreneur side of the equation, the equity financing and crowdfunding has a lot of potential to help overcome the financing gap, provide an alternate source of funding. But in conclusion, from this research, more attention needs to be paid to the investor side of the equation, because the model is growing very rapidly, and if equity crowdfunding is likely to stay around alongside rewards-based crowdfunding, and investors realize that they're not going to make a profitable return, they're going to lose money, the model will be unsustainable in the long run and won't be able to offer these benefits for entrepreneurs as well as investors.